Every major financial crisis follows a predictable pattern, not just the day-to-day recessions or soft landings. I'm talking about a full-blown economic collapse, the kind that erases wealth, crushes jobs, and sends shockwaves across the globe. In today's video, we're diving into the warning signs that show up before every major financial meltdown. We'll look at real historical examples, break down the psychology behind bubbles, and more importantly, how to protect yourself and your family from the fallout. Now, if you've been watching my channel for any period of time, you know this video is a little bit different, as I typically only talk about real estate. But there's so much out there happening on the horizon that I felt like I should do a video like this. So if you find any value in it, make sure you hit that thumbs up and please consider subscribing to the channel. Here's the thing, we all know that history doesn't just rhyme, it repeats. So I want to start today's video by talking about bubble versus recession versus crisis. Here's the thing, most people use these terms interchangeably, but they're very different. A bubble is driven by hype and speculation, prices far beyond fundamentals. Think something like the dotcom stocks or crypto in 2021. A recession is 2 consecutive quarters of negative GDP. Unemployment rises, consumer spending drops, but the system stays intact. And lastly, a financial crisis is when the entire financial system starts to break. Banks fail, lending freezes, and markets collapse. A quick example would be in 2000, the dot-com bubble burst. Stocks fell, but the economy eventually recovered. In 2008, the housing market crashed, triggering a credit collapse, which was systematic. So what actually has to happen for a full financial crisis? Well, there's a 3-part formula, which starts with speculation. When average people are throwing money into assets they don't understand just because everyone else is, that's considered speculation. In addition to that, you have debt-fueled buying. We all know that speculation is dangerous, but when people borrow money to speculate, that's when the real trouble starts. And the third thing that has to happen is a collapse in confidence. Eventually, the hype dies, buyers vanish, and asset prices free fall, which means people can't pay back what they borrowed. And that's when the dominoes start falling. But here's the thing, the signs are never hidden. In fact, the warning signs are usually right in plain sight, but they're easy to ignore. So what exactly are those warning signs? Well, let's start with the LEI. It's the leading economic index. When this starts flashing red, a recession is likely already in motion. And this is about the time when conversations shift. People talk about can't miss opportunities at dinner, parties, barbershops, when you're in the Uber driving around, which ultimately leads to valuations becoming detached from reality. Companies with no revenue are now worth billions. And the last thing that fuels all of this is when banks ease credit. Risky lending becomes the norm. Think about the 2008 stripper scene in The Big Short. It's a perfect example. When exotic dancers start owning 5 homes with no income, the system is clearly broken. So now let's talk about some historical patterns of speculation. Going all the way back to the tulip mania back in the 1600s. Tulips became status symbols. They were even buying tulip futures. Prices soared until they didn't, and because of that crash was brutal. And then came the dot-com bubble in 1999. This is when tech stocks with no profits were skyrocketing. Everyone wanted in, and then the bubble burst and trillions were lost. In addition to that, you have gold and Bitcoin, which is kind of on the forefront right now. And clearly, these are not immune. When people start moving all of their money into one asset out of fear or fear of missing out, you're usually near the top. So what made 1929 and 2008 so dangerous? Well, in 1929, margin trading exploded. People were buying stocks with borrowed money. When the market tanked, they couldn't pay it back, which led to a massive wave of defaults. Banks collapsed, and then the Great Depression followed. Now let's talk about 2008, which is a little bit more recent and the one that everyone wants to reference, especially looking at where house prices are today, where asset prices are today, thinking that we're on the verge of another 2008. But here's the thing, 2008, housing market was driven by subprime loans. Borrowers had no income, no job, no assets, but they still got mortgages. And then when prices fell, a lot of these people couldn't refinance their mortgage, they couldn't sell their homes, so they end up defaulting, which led to banks collapsing and credit markets freezing. Now, in both of these examples, they started as bubbles, but the common factor was debt. That's what turned into the financial crisis. So to answer the question, are we headed for a crisis now? Right now, we're not seeing the same levels of systematic risk, but that doesn't mean we're necessarily safe. Consumer debt is rising, buy now, pay later is fueling over leverage, and speculative buying is creeping back in, especially in AI stocks, meme stocks, and even crypto. And the problem is with social media and instant communication, these cycles are getting faster. The next crisis won't give you as much warning. So if you're looking to protect yourself, there's there's really two main rules. The first is to diversify intelligently. Don't put all your eggs in one basket. Use a balanced approach like Ray Dalio's all-weather portfolio. No, it's not going to double your money overnight, but here's the key. It's not going to get wiped out either. Now, the second thing is common sense, but the problem is most people don't use it, and that's avoid leverage. The fastest way to get ruined in a crisis is owing money on assets that are falling in value. Don't borrow to invest. Don't go out on margin. Make sure you buy real estate responsibly and aim to pay it off sooner than later. Now, personally, I'm a big proponent in learning as much as you can. That's one reason I created a YouTube channel, is to educate people, to guide people through financial advice, through real estate advice, so that you can buy right, borrow smart, and build wealth. So the reason I bring that up is because financial education is your best weapon. If you want to protect your wealth long term, the key is to spend time learning every single day. My goal is somewhere around 15 minutes. Start with reading things like The Intelligent Investor. Study Buffett, Charlie Munger, Ray Dalio. Watch for patterns in markets. The key thing to understand is that you don't need to predict the crash. You just need to avoid being the last one holding the bag. If this video helped you understand how financial crises unfold, do me a favor, like the video, subscribe to the channel, and also drop a comment and let me know what signs you see flashing right now. Lastly, regardless of what asset you're looking at, make sure you buy right, borrow smart, and ultimately you're going to build wealth. I appreciate you watching. See you next time.